This is Tanesse Chang-Gyles with Luxury Niagara Homes at RE/MAX Niagara. Today we're going to be discussing the financial news in Canada. But before we get into that, please click the link below to subscribe to my channel. If you have any questions about buying or selling a property, my email again is tanesse@luxuryniagarahomes.com. My direct line is 416-875-9001. Again, I do have a Toronto number because I started in real estate over a decade ago and I just have not changed my number, but I do currently live in Niagara. Now, let's get into it. Okay, so today we have a significant development from the Bank of Canada. In their recent announcement, they decided to keep the interest rate unchanged at 5% for the month of September. This decision comes as the Canadian economy shows signs of cooling down. And do I mean it's been cooling down? It's definitely been cooling down in real estate, let me just tell you that. The Bank of Canada's choice to maintain the benchmark interest rate at 5% was widely anticipated by economists and financial experts. In a remarkable series of rate hikes since early 2002, the central bank has been successful in curbing runaway inflation. However, it's essential to remember that the effects of the interest rate changes can take up to 18 months to fully manifest. Bank of Canada maintains the key interest rate at 5%. Rapid rate hikes in the past year and a half have successfully addressed inflation concerns. There is a risk of slowing down the economy too much due to the rapid rate increases. Signs of economic slowdown. Recent financial indicators have started to show signs of economic slowdown in July. Job data revealed that Canada's job market lost approximately 6,000 workers, causing the unemployment rate to tick up to slightly 5.5%. Furthermore, GDP data for the second quarter of 2023 indicated a contraction in Canada's economy, marking the first decline since the onset of the pandemic. This raises concerns that the economy might be heading towards at least a mild recession, which we've been hearing about for a long time. Job market data for July showed a loss of 6,000 workers and a slight increase in the unemployment rate. Second quarter GDP data revealed a contraction signaling a potential economic slowdown. These indicators suggest the need for caution and further rate hikes. We also have expert insights on the situation. Jim Thorne, a strategist at Toronto-based investment firm Wellington Altus, believes that there's no good reason for further rate hikes. He even questions the retroactive justification for some of the previous rate increases. Jim Thorne believes there is no valid reason for additional rate hikes. He suggests that the Bank of Canada should have stopped at 2.5% to let things settle. Thorne expresses concerns that the central bank's actions may have gone too far and could lead to a hard landing for its Canadian economy. In conclusion, the Bank of Canada's decision to maintain the key interest rate at 5% for September reflects the awareness of potential risks associated with the rapid rate increases. As the economy shows signs of cooling, experts like Jim Thorne caution against further hikes, fearing a hard landing for Canada's economy. So currently in the market right now, within Niagara region itself, we definitely see a huge cooling off with all the rate hikes. So I've had 6 listings throughout, between June to now, which now we're in October, and the listings were starting a little faster in June, then we slowed down. Every time there was a rate hike increase, it kind of scared everybody and slowed things right down. So Jim is definitely right that the economy right now is not doing too great. People that have bought a house 2 years ago that now have to go renew their mortgage at 6 or 7%, sometimes even higher if you're at a B lender and their annual increase, let's say, is 10% or 11%, and you started off at 5 or 6 last year, and let's say your mortgage is $3,000, now it's gone to $6,000 or $7,000. There's no way anybody can afford that, depending on what job you work at. But the average person can afford, with kids, $7,000 a month just in a mortgage, not including your hydro, water, gas, heating, and all that. So that's why right now in Niagara in particular, we are seeing an influx of listings online from homeowners that may possibly have to renew their mortgage that, can actually, afford their mortgages monthly. So this is a huge issue with all these rate increases with the bank. So hopefully there won't be any more increases, but they say there won't be, but who really knows? We've had a lot of increases over the summer, over the last year, and this has affected many homeowners and also reselling their homes. Like they can't get as much equity out of their homes now if they're trying to repurchase something, let's say in Niagara. Let's say you're from Toronto, you're selling for 1.2 million. You're trying to come here and buy a home and maybe downsize or upsize, but some of the homes in Niagara are still at, $1 million or 950 for detached homes, because those homeowners can't go lower because they bought for a higher price 2 years ago. So there's definitely an issue with the economy right now. I definitely think it's definitely a hard time, for realtors in real estate. No, we have to amplify our marketing for listings, pricing your home right, and trying to get that home sold for a good price so that your seller's happy, and then so that the buyer can also afford to buy the home or afford that monthly mortgage. So that's all for now. Let me know what you think about the rate increases in the comments below. Happy to respond to you and have a discussion. This is Tanesse with Luxury Niagara Homes. Bye for now.